Hi, this is the Philosophical Angle, and I am your host, Chris Angle. I am the author of 4 books on philosophy, one of which is The Philosophical Equations of Economics. These books are available free for viewing at www.philosophypublishing.com. The purpose of the Philosophical Angle is to examine and explicate the nature of the concepts and topics being used in current media, and compare its essence with the usage and circumstances and how they're being used. Today with me is my panelist, Rick Samuelson. Rick graduated from Yale, has an MBA from Wharton, an MA from Tufts. He's retired from the investment banking industry and is now an independent venture capitalist. Welcome, Rick.
Thank you.
This week, the topic for discussion is the unemployment rates of Europe compared to the US and its significance. Let's begin. First, in order to really understand unemployment and the nature of unemployment and the nature of a job, we need to go into the concept a little bit and understand the nature of a job and the nature of investment and the nature of not having a job, which would produce our unemployment problem. That's here in the United States, and even worse, it is in Europe. So first, when we go to a job, every time we go to work, or really we do anything that we do, we sacrifice something. We sacrifice our effort. We sacrifice our time. We use our knowledge amidst an atmosphere of risk or opportunity. And we do this to produce and acquire a reward. We do everything for a reward. And so we're going to write this as our sacrifice related to our risk, our information and knowledge, our time and our effort. And that produces a reward for which we get compensation. Our reward is our compensation. So this risk, investment, knowledge, time, and effort, if we do it individually at home, or for example, we're building a deck, and so we have to sacrifice our energy and time to build it, or we do it at a job. It's the same thing. It's the same decision, and its essence is the same. So we go to work to achieve a reward and compensation there. So our risk, our knowledge, our time, our effort, if we add in an efficiency to that, so let's say our knowledge has come along and we've been able to apply that to our time and effort and material that we use, and we realize that we have a new product, a new invention, and this new invention makes us more efficient. So all efficiency comes out of the efficiency of the risk and the opportunity, the knowledge, the time, the effort, and the material that are involved. And from that efficiency comes a profit. And when we have more than a little more compensation from our newly found efficiency, we call that a profit, and from the profit we're able to invest. So we're going to call that a little bit larger profit from our sacrifice of our time and effort and our knowledge, plus that efficiency. We get a little bit larger reward. So we'll segment that off. We'll call it reward 2. And we add that to our basic reward. And that reward 2 is equals to that profit. And from that profit, we get an investment. And we can take that profit and invest in the future for a future reward. And from that reward, we're going to be able to trade that future reward with demand that other people will have for it. Because all rewards are something that you perceive as good. And hopefully other people perceive it also as good. And so they'll want to trade your good for their good, because they've also gone out and worked and sacrificed their time and effort and knowledge to get their rewards. So you can swap the rewards. It's called a marketplace. And when that happens, the increase of the efficiencies on these rewards, jobs for others are created. And they're created exactly from our risk, our time, our effort that produces goodness that others may want to enjoy and profit from and trade for their rewards. So the flow of, to summarize, the flow of action is our sacrifice on our risk, on our time, on our effort, on our material. We apply, out from which we can get an efficiency, which we can get a profit, which we can get a job. Now, what can prevent us from this happening? One of the things that will prevent this are laws and regulations that the government might establish. For example, an EPA might come along and say, well, you know, this won't be good for society. So they'll create a regulation. And so the sacrifice that you were going to make on your risk, time, and effort and material cannot be made, or shouldn't be made, or whatever it is. Some regulations are good, and probably some are not. But this also, risk and laws can prevent an incentive from happening, and prevent our flow of job production. Also, at this end, on the profit, the government can come along and take its income tax. It takes its fair share of, as they put it, and they will disperse it either to transfer payments to people throughout who they perceive as needy. But worse yet, the government also, in everything it does, is inefficient. And so this inefficiency is a tax and weighs upon the production of jobs, as it impinges upon this line of, or this process. So now let's go to, with that being said, let's now go to something that the Heritage Foundation and the Wall Street Journal have combined to produce is something called the Freedom Index. And I'm going to use that to establish the difference between the United States and Europe. Because unemployment presently in Europe is about 11.8%. And for youth, it's coming close to 50% unemployment. So it's even worse than what we have now here in the United States and have had for quite some time. Europe is also suffering from the same problem, but even worse, unemployment. So we're going to use the Heritage Foundation to see if there's a difference between the US and Europe. Well, this Freedom Index is made up of 4 groups. It's made up of the rule of law, and examples of the rule of law would be property rights, freedom from government corruption, Second group is limited government. An example of that would be government spending. Well, government spending in Europe is quite something, as we've seen from throughout the last couple of years with the crisis in Greece and Italy and Spain and Portugal and even some say that France is now in trouble too with its government spending. But United States is no particular sterling example of government spending, as our deficit is exploding. Another part of the freedom index is regulatory efficiency. Business freedom is an example. Freedom of labor, that is, people who want to go from one job to another, or they want to organize and become a union, or whatever it is, as long as we have freedom of labor. And monetary freedom. Last part in the freedom index is open markets. Open markets meaning like free trade or open investment. In other words, you can do with your money in investment as you please. No one's telling you where to invest your money. So those are the four main parts to the Freedom Index. And the Heritage Foundation has categorized them as the top 5 to be free, the top 6, from the top 6 to the top 15, to be mostly free societies, and the scores between 36 and rankings of between 36 and 85 are moderately free, and the rankings of 86 onward down the list to the end as mostly unfree. Well, the US is 10th on the list. It used to be higher, but it's fallen a little bit. But nevertheless, 10th, which is mostly free. Example of some of the totally free are Singapore and Hong Kong, which are top of the list. Europe, taking a look at Europe, the Netherlands is ranked 17th, not bad. Luxembourg, 15, not bad. Denmark, 9, pretty good. Beats the United States, who would have guessed? Germany, 19, not bad. Just out of the mostly free into the, well, that's probably, should be 35 instead of 15. Spain, 46. Okay, now we're dropping into the moderately free. Portugal at 67. Italy at 83, almost mostly unfree. And Greece at 117, obviously mostly unfree. Average 46.6. Well, if you take this average of 46.6 and compare it with 10th in freedom, now then it becomes obvious that it might be logical that Europe would have a higher unemployment rate. But let's take these 4 sections or 4 parts of the Freedom Index and see where they are here back in our chart, in our flow chart, understanding the nature of a job. The rule of law here in creating the efficiency and creating a job is tantamount so that contracts can be made and understood and adhered to and valued, which in the United States is pretty good. We have strong property rights. Second part is limited government spending. Well, as we've seen here, this is increasing. Our income tax, our taxes are increasing. The government share of the total pie is increasing. Thus, their inefficiencies are involved in profits. So we're falling in that direction. So our limited government is helping to impede job growth. Our regulatory efficiency, such as business freedom and labor freedom, that's pretty good. I think overall we score fairly high on that. And then back in open markets, pretty good. We have people are pretty free to invest where they will. So the biggest part are the regulations here in regulatory freedom efficiencies, which are pretty prevalent in the United States. I believe I read that last year about 70,000 pages of regulations were produced in the United States. Rather burdensome. So I'll stop speaking now and let's go to our host or our panelist and see what he has to think about and say about what we've just gone over. Rick, any thoughts in general about job creation in Europe and the United States?
Well, I guess the first thing to note is that politically, Europeans seem to tolerate much higher levels of unemployment and poor growth and so forth than Americans, and have done so for many years, with the possible exception of Germany, where actually unemployment is lower than it is here, and growth has flattened out recently, but over the last, certainly over the crisis period, which was higher than that of the United States by quite a bit. So the remarkable thing about Europe is that radically differing performance levels coexist within a monetary union. So you can have high double-digit unemployment in Spain and Greece, and 4% or 5% unemployment in Germany, yet they share the same currency. This is kind of odd, because you would have thought that over several years there might have been more natural integration if people are free to move and work where they please, and if the regulatory structure over time is harmonized more, then you would have expected, I guess, more harmonization in the performance of these economies, and it clearly hasn't happened. In fact, you could argue that it's gone the other way, that because states like Greece and Italy and Spain have been anchored to the euro, their currencies have not been allowed to devalue in line with the performance of their economies, which has meant it has not forced an adjustment upon them. The Economist and the Wall Street Journal and others have made this point before. So this differing level of performance, persistent differing level of performance within Europe has been worsened by the euro, it appears, and rather than helped. So that's the first point I would make. Relative to the United States, it would seem that, and this is over several years, Germany has made enough of the right choices, especially given that they started with a rather difficult situation when they integrated East Germany and had to combine the two currencies then. This is going back many years, and had very inflexible labor markets, high cost of production. They seem to, over a number of years, deliberately adjusted their regulations and their labor markets and the flexibility of their labor markets, at least within the country, not benefiting Europe so much, that they've actually outperformed the United States. So I mean, there's a cautionary tale. There's a lesson there, and one wonders what condition Europe would be in right now without Germany. Exit Germany from the formula, and what would the financial system in Europe be like now? Who would be looked to pay the bills? Who would be looked to stand behind the European Central Bank? Well, there's no obvious candidate.
Right. You know, you've made an interesting point about the euro as opposed to individual currencies. Has the euro helped or hindered the problem of unemployment in Europe? Is there a relation?
I think the euro has exacerbated the unemployment problem because it has helped make the allocation of capital more inefficient. So, you know, countries like Greece and Spain are not producing the sorts of goods that are appropriate to the level of skills and the level of infrastructure. And I'm talking about industrial infrastructure now, I'm not talking about simply roads and bridges, that their countries have. And furthermore, it's obviously encouraged, or certainly hasn't discouraged, a lot of relatively inflated asset prices, because being that these assets are denominated in euros rather than in the local currencies, the original local currencies, as the euro has performed on the strength of largely German productivity and a few other countries, the asset prices in the southern tier countries have been artificially increased. So it's made them less desirable as a place to invest for productive activity.
Well, what about if in previous times when the countries had individual currency denominations, weren't they tending to inflate and pay back their debts in dollars of less in their currency of less value than at which they borrowed? And wouldn't that be a detriment over the long run to their economic health?
Well,
because the euro, they haven't been able to do that with the euro.
Yeah, well, prior to the euro, they played that game many, many times. There were kind of competitive devaluations and so forth. Italy was notorious, and Greece, etc. But at that point in time, because they had their own currencies, of course, the rate they would pay on their bonds increased when they showed signs of financial strain. And you can't fool investors all of the time. If they anticipated that the currencies were devaluing, they would only allow these countries to borrow so much. So, and I'm not the first to point this out by any means, you could argue that the borrowing and funding of welfare benefits in Greece, Italy, and other countries was, supported by joining the euro, because they weren't paying a fair price for the capital they were borrowing, and it encouraged them to borrow more than would have been the case earlier. And that's why the debt to GDP ratios in these countries have skyrocketed.
Well, in that sense, then, the euro has been a healthy component, in the sense that it's bringing austerity or some recognition of the problem to light. And I suppose, therefore, we've had the Greece crisis and may have others right behind it from Italy, Spain, Portugal, and maybe even France. So it seems on one hand the euro has been good. On the other hand, it might have been detrimental to the unemployment problem. Overall, what do you think, Rick?
I think it's been too much of a temptation for the southern tier governments, and if they had to do it all over again, I suspect in their heart of hearts, the leaders of the EC would have confined the euro to the northern tier of countries, like Germany, Austria, Netherlands, and so forth, and several others, maybe including France, maybe not. And the fact that the structure of these economies is relatively similar compared to the southern tier or outlying countries, it just makes it extremely difficult. Because in practice, you have different languages. You can't easily ship employees who speak Spanish up to Germany and have them operate technical equipment in German. It doesn't. I mean, it's not that easy.
One last question, Rick, before we have time. While we have time, we just have like to ask, what do you think the United States should do in order to bring down the unemployment rate? We got about a minute left. Go ahead.
Okay, that's a tricky one. I can tell you this: working in venture capital, access to risk capital, whether it's in the form of borrowings or equity, is extremely difficult at the moment in the United States. And that's one reason small companies, which are the source of most jobs, aren't investing as rapidly as they are. They can't get the capital. In some cases, I'm sure they're hesitant about investing, but in other cases, they just can't get the capital. It's extremely difficult. So I think that's one area which is not talked about enough in terms of hampering employment generation in this country, because it's not going to come from large companies. It will come mainly from smaller firms.
What do you suppose? What do you suppose is the reason for the capital not flowing into new ventures that deserve it?
Well, I think we have generally government policies that are not pro-business. We have regulatory overreach in many areas, whether it's environmental protection or the healthcare insurance burden. I mean, already companies around here are talking about keeping the number of employees below 50, so they don't cross the threshold in terms of having to pay a lot more for the new Obamacare health insurance. These kinds of distortions don't help in an economy that's already weak.
Okay. Well, I want to thank you, Rick, for joining us, and Rick will be with us in many future editions of the Philosophical Angle. And so see you next week. Thanks very much for joining us.
Okay, thank you.